Let me tell you what the headlines got wrong this week. The headline said silver supply is balanced, the market is stable, and there is nothing urgent to watch. Here is the reality. One of the top 10 silver-producing nations on the planet just quietly restricted its silver export flows by roughly 40%, and you did not hear it from a single mainstream financial outlet. Not from the major wire services. Not from the big commodities desks. Not from the banks putting out their weekly metals notes. The story passed by them entirely. And that is the most dangerous thing I can tell you, because this kind of move never stays quiet. It starts quiet on purpose. And I think you deserve the full story. So here it is. I am recording this right now from Los Angeles, and I want the timeline to be crystal clear, so comment below with what day and date you are watching from, because this story develops in real time, and I want to see how far this video travels as the situation unfolds. And real quick, if you value this kind of geopolitical under-the-radar market analysis, do me a favor, subscribe and comment FinTalk OG so the algorithm knows you want more of this and not the surface-level noise. Now, in case you have not seen what I am talking about here, is the claim making the rounds in the small corners of the commodities world that actually track this stuff. The claim is this. One smaller producing nation made a bureaucratic adjustment to its export licensing process. It is administrative. It is temporary. It is not a market-moving event. And on the surface, that sounds measured. It sounds like context. But when I traced where a lot of the dismissive takes were coming from, they were not from analysts who had read the actual policy language or tracked what this particular country had done in previous commodity cycles. They were from commentators summarizing other summaries. And that is not the whole story. That is not even close to the whole story. The first place these narratives get weak is when you assume that what a government says publicly about why it is restricting exports matches what it is actually trying to accomplish. That almost never holds up. Resource nationalism does not announce itself. It disguises itself as administration. So in this video, I am going to break down 3 things. First, the resource nationalism playbook itself, because this has a pattern, and the pattern is consistent across countries and across decades. Second, the actual supply exposure this creates, and why time is the weapon here, not the announcement. And third, what you need to be watching and doing right now if you hold silver or any silver-related equities. You are going to walk away calmer, sharper, and more in control of what you own. So let us start with what we can verify, and that is the playbook, because this is not new and it is not random. Here is what nobody wants to say out loud on the mainstream financial media platforms. When a resource-rich government restricts exports of a commodity, it is almost never driven primarily by what it says it is driven by. The stated reasons are always the same: domestic processing incentives, environmental review requirements, revenue optimization, protecting local industry. Those justifications are real in a technical sense, but they are not the engine. The engine is leverage. The engine is positioning for a negotiation that has not been publicly announced yet. I have watched this cycle play out with tin in Indonesia, with lithium in Chile, with copper in Zambia, and with rare earths in China. The structure is identical every time. It starts with a quiet administrative change. An additional export license step gets introduced. A new processing requirement appears that favors domestic refiners over raw ore exports. A fee structure gets adjusted in a way that makes export marginally less profitable. None of it sounds alarming in isolation. Then industry players start complaining privately about delays and compliance friction, but they keep it internal because they do not want to create a diplomatic incident that jeopardizes their operating agreements. Then the tightness shows up in regional physical premiums and in trade flow data before it shows up in the benchmark price. And then somebody eventually writes a big headline about it, and by that point, every investor who was paying attention is already positioned, and the easy entry is gone. That is the full cycle. Based on what current trade data and policy commentary are showing right now, we are sitting between the private complaints phase and the physical premium signal phase. That is the window. That is exactly where you want to understand this before it becomes obvious. Think about it like a reservoir. Right now, the inventory of available silver from this country looks manageable because the tanks are still drawing down from earlier production that already cleared export. The inflow pipe has been narrowed, but the reservoir has not drained visibly yet. It looks fine on the surface, but the physics of a narrowed inflow pipe are inevitable. 2 quarters from now, the reservoir level tells a different story. And the price discovery mechanism does not wait for the reservoir to run dry before it moves. It moves when informed participants begin pricing the trajectory, not the current level. Time is the weapon here, not the announcement. The announcement always comes last. Now here is the skeptical alternative, and I am giving it genuine space because intellectual honesty matters here. Could this export adjustment be genuinely temporary, purely administrative, and resolve itself within a normal policy review cycle without any lasting supply disruption? Yes, absolutely. It has happened before. Several producing nations have tightened and then reversed export restrictions when the economic pressure or trade negotiation outcome shifted. I am going to say something that might annoy both sides here. Temporary restrictions that resolve cleanly are a real historical outcome. That is plausible here is how it can fail. The political environment in resource-producing nations right now is fundamentally different from what it was even 5 years ago. Commodity revenues are not just economic policy instruments anymore. They are domestic political capital, a government that can point to controlling a critical export input and use that as leverage in trade negotiations with wealthier consuming nations is incentivized to hold that card longer than market participants assume. And here is the compounding factor that nobody models correctly. When one country runs this playbook and does not immediately collapse economically, it signals to 2 or 3 other producing nations that the move is lower risk than previously assumed. Bolivia, Kazakhstan, and Chile have not operated in isolation. They watch each other. A correlation is not a contract, but when you see similar policy moves cluster in the same 18-month window in multiple producing nations, that is not coincidence. That is contagion in resource policy, and it compounds the aggregate supply impact far beyond what any single country's restriction would suggest in isolation. So what does this actually mean practically? And here is what to watch right now. Do not watch the silver spot price for early signals. That is the last place this shows up. Watch 3 things instead. Watch the trade flow tonnage data from the country in question, because export restriction enforcement appears in physical shipments before it appears in official policy updates. Watch regional physical market premiums specifically in markets that are geographically dependent on this supply source, because when a supply source tightens the physical buyers in that region, start paying above benchmark before the benchmark moves. And watch the earnings call language from mid-tier silver producers and refiners that have significant operational exposure to this country, because corporate executives will flag supply chain friction in investor calls before it becomes a news story. Those 3 signals in combination give you a materially better picture than any single headline. Here is a question for you, and I genuinely want your input in the comments. Which country do you think represents the single most underpriced export risk to global silver supply right now. Is it Bolivia? Is it Kazakhstan? Is it Chile? Or is there somewhere off most people's radar entirely that you think is the real vulnerability? Drop it below, because the answers from this community consistently outperform the consensus in the research notes I read. Now let us talk about the equities exposure angle, because this is where the story becomes directly actionable, and it is where most retail investors stop too early. The silver mining equity space does not carry uniform jurisdiction risk. Let me be blunt about this. Some producers have deliberately diversified their operational footprint across multiple continents precisely because they understand what resource nationalism looks like when it arrives. They have built some insulation. Others are deeply concentrated in exactly the kind of single-country exposure that the export restriction story targets most directly. Here is the clean way to think about it. Picture a shopping mall. Some tenants are anchor stores with 20-year lease agreements and deep relationships with the building owner. Some are smaller pop-up retailers operating on short-term arrangements with minimal negotiating power. When the building ownership decides to restructure the rental terms, the anchor tenants have leverage in the negotiation. The pop-up shops do not. Junior miners with single jurisdiction operating licenses in countries currently running the resource nationalism playbook are the pop-up shops. They have the highest operational leverage to this kind of disruption and the least negotiating power when the regulatory environment shifts under them. Now, the skeptical counterpoint on this is fair. Could larger, more diversified miners absorb a single jurisdiction disruption and continue operating without material earnings impact? Absolutely some can, and they have done it before. I am going to say something that might annoy both sides. Scale and diversification genuinely matter in mining, and the biggest operators have survived multiple waves of resource nationalism by having more geographic options. That is plausible here is how it can fail. Reserve estimates and production forecasts are built on specific access assumptions in specific jurisdictions. When the legal and regulatory framework changes in a country where a company has a 20-year plan deployed the financial model does not bend smoothly. It breaks and gets rebuilt. That process takes capital, time, and legal expertise that smaller companies simply do not have. Stay with me on this because it matters. The market very often prices in a rapid resolution timeline before the actual resolution timeline becomes clear. That gap between the assumed recovery speed and the actual recovery speed is where retail equity investors absorb the most damage. Do not just chase the spot price story on silver. Chase the jurisdictional exposure story on the equities instead, because that is where the pricing asymmetry right now is most actionable. Tell me in the comments. Do you currently hold silver mining stocks, and if so, have you looked at the actual geographical breakdown of where their reserves and their current production are located? Because that number tells you more about your real risk exposure than any analyst rating. Drop your answer below, because I read everything. Now here is a simple action plan. No drama at all. Step 1. Write down the jurisdictional breakdown of every silver mining position you currently hold. What percentage of their production and their reserve base is located in countries with recent or emerging resource nationalism indicators? Write it down. If you do not know the answer, you need to find it before the next quarter, not after. Step 2. Build a simple watch list document with the 3 indicators I just walked through. Trade flow data from the producing country, regional physical premiums, mid-tier miner commentary in earnings calls. Review it every 2 weeks, not every day. You are not trying to scalp this setup. You are trying to be informed before the headline arrives. Step 3. Decide this first before adding any silver exposure right now. Is my entry thesis based on the geopolitical supply disruption story or on the broader monetary metals case? Those are two legitimate reasons to own silver, but they have different expected timelines and different exit triggers. Mixing them up without clarity is how you make the wrong decision at the wrong moment. Decide which game you are playing before you size in. Step 4. Do not make the common mistake of substituting a high-risk jurisdiction junior miner for physical silver in your portfolio and treating the risk as equivalent. It is not. A junior miner with concentrated single-country exposure is an amplified directional bet with operational and political risk layered on top. Know exactly what you own. Know exactly why you own it. Now let us map two honest paths forward without pretending we can predict the candle. Path 1 is the escalation and repricing scenario. The initial country's restriction holds longer than consensus expects. One or two other producing nations run a similar playbook within the following few quarters, seeing that the first mover absorbed it without catastrophic economic consequence. The aggregate supply tightness becomes visible in registered exchange inventory drawdowns. Physical premiums in import-dependent regions widen noticeably. Paper pricing catches up to physical reality with its usual lag, and silver moves meaningfully higher. Mining equities with clean diversified jurisdictional profiles outperform, and the concentrated single-country names face earnings revisions that the market has not yet priced. I am not predicting it. I am saying it is within the set of things this market is capable of doing, and the policy trajectory currently points in that direction. Path 2 is the negotiated resolution scenario. The producing country receives sufficient trade negotiation pressure or bilateral economic incentive that the restriction gets quietly walked back within 2 or 3 quarters. The supply disruption gets absorbed by existing above-ground inventory and by modest production adjustments from other sources. Mining companies reroute their logistics, and the market begins pricing in normalization before any visible shortage develops. Silver stays in a consolidating range. Equities with concentrated exposure recover gradually over time. Same asset, different interpretation, entirely dependent on whether the political calculus in that country shifts. Both worlds are real possible outcomes. That is not a crash call on the mining sector. That is a maturity call on the geopolitical timeline. Now here is the uncomfortable truth, and I need you to hear this clearly. Even if the supply disruption thesis plays out exactly as the structural case suggests, silver and silver mining equities can still get sold hard in the near term by forces that have nothing to do with silver export policy. When broader markets get stressed and margin calls go out and portfolio managers need to raise cash, they liquidate what is liquid and what has appreciated. Silver positions often fit both descriptions. You can find yourself in a situation where the exact supply tightness event that should theoretically drive prices higher is happening simultaneously with a macro risk-off event that is pushing silver lower, because leveraged holders are being forced out. This is not contradiction. This is mechanics. And here is what nobody wants to say about the institutional side of this. The major institutions that manage large silver derivative books know what the trade flow data shows. They have better information, faster information, and more sophisticated models than any retail participant. They are not publicly alarmed. They are sitting at the poker table, quietly building their position before the announcement that will justify it. They will tell you the market is balanced right now. Watch what the inventory and premium data tells you instead. Here are 4 rules, and these do not change regardless of how strong the thesis looks. 1. Decide your maximum allocation to silver and silver equities before you take any new positions. Write the number down. If you are losing sleep, your size is already wrong. 2. When a position runs, meaningfully take some off the table. Not all of it. Some. If something doubles, consider trimming close to half. You lock in the original capital. You let the remaining position run. You do not need to prove anything with a full position. 3. Do not keep all of your silver equity exposure in one or two names. The jurisdiction risk I described is exactly the kind of risk that hits a concentrated position catastrophically and hits a diversified position manageably. Spread it. 4. The best time to buy is not when you are most excited about the story. The best time to buy is when you can still breathe. Right now, while this is still a quiet policy memo story and not yet a front-page metals crisis, the setup is cleaner than it will be when the headline lands. So here is what we covered. Resource nationalism follows a consistent playbook that starts with quiet administrative changes and ends with market repricing that rewards people who understood the mechanism before the headline. The reservoir dynamic means the supply impact is invisible until it is undeniable, and by the time it is undeniable, the cheap entry is gone. Mining equity exposure is not uniform, and understanding the jurisdictional breakdown of what you own is more valuable than any sell-side target price. And the policy contagion effect across multiple producing nations is the compounding factor that most models completely miss. The export mechanism is doing something right now that most investors will not understand until it is far too expensive to act on. Stay alert. Do not let a week of quiet news talk you out of watching the trade flow data that is already telling the story. Now here are my questions for you. First, which producing country do you think is the most underappreciated silver export risk in the world right now, and why? And second, when you evaluate a silver mining equity position, do you look at jurisdictional concentration as a primary risk factor, or is it something you have not been tracking? Drop your answer below, and remember to include what day and date you are watching from, because I want to track how this story develops relative to when people are finding this video. If you got value out of this, subscribe and comment FinTalkOG so I know you want to follow up when new trade flow data confirms what the policy language is already telegraphing. And if this helps, share it with someone who holds silver mining stocks but has never asked the question of where those mines actually are and what political environment they are sitting inside. Keep your head clear, and I will talk to you soon. And just so we are crystal clear, this is educational content. It is my take based on publicly discussed information and my own reasoning, and it is not personal financial advice. I am not your advisor. I do not know your goals or your risk tolerance, and I could be wrong. Do your own homework. Consider your situation, and if you need personal advice, get it from a qualified professional who knows your situation.